Greetings, everyone. I'm Kathy Wood, CEO and CIO of ARK Invest, and this is In the Know. The last few months have been quite rewarding in the financial markets, and we think there is good reason for that. If we look at the economic data, both in real terms and the inflation data, we're seeing a weakening in the economy, much weaker inflation, both lower than expected, and the Fed is beginning to change its tune. So just to rattle off a few of the statistics, JOLTS, the job opening index, is now dropping fairly precipitously. Temporary help employment is falling. That's a leading indicator. We did get the employment report today. It had something for everyone. I would say it was on balance a little stronger than expected, but temporary help, a leading indicator, continued to fall. It's been falling since the Fed started tightening. We had leading indicators. I think they're down now for 16 or 17 consecutive months, down about 10%. We have never escaped a recession when leading indicators have dropped 10%. We had retail sales, industrial production, existing home sales, new home sales, and capital spending as measured by non-defense capital goods, all negative on a month-to-month basis, mostly the month of October. We had the CPI and the PPI come in lower than expected. Now the PPI is up only 1.4% on a year-over-year basis. And so we believe that the Fed is getting ready to pivot. And we do believe, with history as our guide, that we'll look back at what happened during COVID and after COVID as transitory after all. And I think that's beginning to impact the thinking at the Fed as well. So that's been very good for the financial markets, both the equity market and the fixed income market. It has not been great for the commodities markets at all. And it has also been very good for Bitcoin and cryptocurrencies and crypto assets at large. So as usual, we'll go through fiscal policy, monetary policy, economic indicators, market indicators, and then we'll wrap up with a little discussion about innovation. All right, so here we go. Fiscal policy. This is, again, the federal budget deficit as a percent of GDP. It is very high by historical standards, meaning the deficit, the more negative, the higher the deficit. And we now have a new Speaker of the House who has to navigate a very difficult situation between Democrats and Republicans. But one thing I believe will not happen, and that is big spending programs, even though we're going into an election year. Very often in an election year, spending programs pop up all over the place because it's an election year. And representatives, senators, others want to give their constituencies good news. I don't think that's going to happen this time. And I think, in fact, we'll probably see surprising spending restraint. So I think if we're right, what will happen is spending restraint, but the economy softens. So it'll probably stay in this range for a while until we enter a recovery. So let's move on then to monetary policy. So money supply started falling in July of 22 on a sequential basis. Since then, it has dropped 5%. Now, on a year-over-year basis, it's down roughly 3.5%. and you can see maybe it's ticking up a little bit, but that's only because we're now comparing against declines a year ago. So the so-called comparisons are getting easier. So very weak monetary supply statistics, and we're seeing the monetary base has dropped from, I think it was $8.5 trillion at the peak to now about $7.7 trillion. So real shrinkage out there. Now, I've talked about velocity before. What has offset this decline and kept GDP growth moving up in the last year? It is this chart, velocity. The velocity of money has been moving up, and it's a cyclical move. So you can see the velocity of money, as measured by M2, peaked in 1997 and has been in a downtrend ever since. You can see during recession, so 2000 to 2002, velocity drops at an accelerated rate. You saw that again in 08, 09, and you really saw it during COVID. And what's happening now is we're just moving back to trend. And I think trend is at about 1.4, so we have a little bit more to go. But if we do enter a recession, and as you know, we think we've been in a rolling recession for roughly 2 years now, starting with back-to-back declines in real GDP in the first half of 2022. And of course, we've seen housing measures drop by up to 40%. Autos are in recessionary territory. We're seeing non-residential construction, especially in the office space area, in desperate straits, offset somewhat by IRA spending, the Inflation Reduction Act spending, which is focused more on infrastructure. But nonetheless, rolling recessions, and we think the next sector to pull back probably is the consumer. We're already hearing from retailers that the discounting is picking up in order to attract consumers into good deals. And we're hearing words like deflation used by a company like Walmart, very interestingly. So we'll get back to trend. And then, of course, the risk in a consumer downturn is that this velocity measure continues down, that it resumes its downtrend. And what would that mean? It would mean we'd have money negative on a year-over-year basis, and we'll have velocity starting to roll over. So that's how you get a really hard landing, unless the Fed pivots and money supply picks up dramatically. So in an election year, now the Fed is independent, but the Fed tends to stay out of politics and not make moves to favor one party or the other. But we do think it's going to be forced to ease by economic statistics that will make it overwhelmingly clear. And that's a word that Larry Summers used today. He advised the Fed not to change policy, not to cut interest rates until there was overwhelming evidence that the economy is weakening and inflation was coming below the 2% territory. We think there will be overwhelming evidence, and that will happen next year. So now let's go into, one other metric that I wanted to share. We did this last month as well, but I forgot to mention something. So this is the yield curve. It's the difference between the 10-year Treasury yield and the 2-year Treasury yield. And during recessions, and the recessions are in the shaded areas there, the yield curve either goes negative right before the recession or in the middle. You can see for the most part, it is a leading indicator. In the 80s, it was late 80s as well, into the 1990 recession. It inverted again. Inverted means went back below zero before the 2000 tech and telecom bust. Same thing with 08, 09, and here we are again. You can see the yield curve is inverted by more than in any other recession except the 80s. Now, the other thing that I wanted to mention here is you see where the yield curve goes during a recession when the Fed is stimulating and fiscal policy is also stimulating. It usually goes to the 2 to 3% range. What does that mean? It usually means 10-year Treasury yields are 2 to 3 percentage points higher than the 2-year Treasury yield. And you'll notice that during COVID, that did not happen. Interesting. And it is surprising because the world threw all kinds of monetary and fiscal policy stimulus at the COVID problem. And one would have thought that we would at least get back to the 2 to 3 percentage point area. We did not. Now, why? If we are correct, the reason is because the bond market is sniffing out a deflationary world out there. And so yields, long-term yields, just didn't go as high as many people expected them to go, and relative to 2-year Treasury yields. And it's because they're looking at these undercurrents of deflation. Lower inflation or deflation would keep long-term Treasury yields down. And we were looking at this in the day, and I was saying, wow, I didn't appreciate that all that stimulus couldn't get this yield curve back into the usual 2 to 3% range. Now it is more inverted than the past 3 times. Have to go back to the early 80s. And that just tells us that monetary policy is a lot tighter than most people appreciate right now. And after the last set of numbers from October, lower inflation than expected, lower activity than expected, you can see expectations now for the Fed funds rate to come down. This is what the futures market is thinking in the last few weeks. So we're happy to see that it is corroborating our thought that the Fed is going to pivot. Okay, now on to economic indicators. Here is a chart showing what expectations have been for fourth quarter GDP growth ever since October. And you can see in the GDP now purple line there, that growth expectations have been coming down. Bloomberg expectations were very low and seem to have come up, but they're both converging into sort of the 1 to 1.25 range, which is very low, of course, and not too far from negative, which is where we would not be surprised to see real GDP growth go some point next year. Now, we got consumer sentiment measures today. You can see, just going back into the early 80s, you can see that consumer sentiment is quite depressed by historical standards. We did get a little bit of a pop today. We've been hovering in that 60 to 70 range, got closer to 70 with today's reading for this reason. expected inflation rates. So you can see that if you look at the 5-year, the longer-term inflation expectations as shown by the green line, they never really veered from where they've been since 2000, which was a disinflationary time. It was those short-term, the next year expectations that popped above 5%, which is not terribly unusual. The same thing happened as the Fed was stimulating in 2008. And then, of course, they came right back down. They're coming down again now. We had an unusually large decline. It had popped to something over 4%, and now we're back down to the low 3%. And you can see, again, that's not too far from where we have been. And yet the Fed has been fighting this inflation dragon. You'd think that expectations were where they were in 1980 and had been building for 15 years. We got to 10% inflation expectations then. We got nowhere near that. And yet the Fed, with a 24-fold increase in interest rates from 0.25 to 5.5% in little more than a year's time, has been slaying a dragon. We don't think that dragon existed. And we do think we'll see the ramifications of this policy during the next year or so in the form of much weaker than expected inflation and economic statistics. We wouldn't be surprised to see the broad-based inflation gauges go negative. And then, of course, the Fed will be fighting a completely different battle. Here is temporary help employment. You can see it's a leading indicator. The green line is total employment. Temporary help is the purple line. And by this time in past cycles, the total employment was about to turn down when temporary help had reached this kind of a decline. And we do think that will happen next year. That's part of why we think consumption will pull back. Purchasing Managers Index, this gives you a sense of where we are both in manufacturing and services. Manufacturing's the green line, services is the purple line. And 50 is the demarcation point between expansion and contraction. So you can see that the manufacturing sector has been contracting since late 22, roughly a year now. It is in recession. Services sector has held up at a weak level, and this is what will probably give way if the unemployment rate kicks up and consumption starts to falter. New home prices, this one to me is startling. Talk about deflation. Now, new homes are in short supply. Why? Because most people in existing homes have low mortgages and don't want to give them up, so they're kind of staying put. And so the turnover for existing homes is very low by historical standards, and the only availability is in new homes. And yet, look at what just happened. 18% year-over-year decline in the median price of new homes. And so what is that telling us? It's telling us mortgage rates are just way too high. They have started coming down along with long-term interest rates recently, but you can see, go back into the vicious recession of the early 70s, when I believe wage price controls had started, and there was all kinds of chaos going on in the economy, including shutting the gold window. We haven't seen a price decline like this since then, and it's worse than what we saw during 08-09, which is the most massive housing recession we've ever seen. So This chart is speaking volumes to us. Auto sales. Now, if you look at this chart, you'll see we're kind of in the middle of where it has cycled. It's a very mature industry, and so it's in the middle. But the steady state in a recovery and an expansion has tended to be closer to 17 million units, and we're at 15 million now. And we are beginning to see that in order to sell cars, auto companies, auto dealers are discounting more aggressively. One of the reasons they are is used car prices are starting to come down in a fairly dramatic way. They're down only 5% on a year-over-year basis, but taking a shorter term time frame, they are down more, and we think they will continue to move down. Here is China's PPI. One of the things we've been saying, and we've gotten some proof of it recently, is that China is exporting deflation. So you can see that its PPI is the purple line, down. It's been fluctuating in the down 2.5% to 5% range. And import prices from China are down roughly 2.5%. This is at the PPI level. At the consumer level, we've been struck by Meta Platforms' disclosure during its earnings reports over the last year that one of the biggest reasons its advertising has picked up is Chinese advertising. And so we're seeing much more advertising from Temu, which is PDD's arm that is sending goods to the rest of the world from China, and Shein, which is the fast fashion, very low prices, also becoming much more aggressive outside of China. And that is causing trouble for the dollar stores, and we think the troubles are going to multiply. China's economy, we believe, is exceedingly weak. Property prices have not increased. They're still down by some measures, 20% on a year-over-year basis. And 70 to 75% of consumer savings in China are in the form of property. So they've been hit, and sentiment is not good there. And so it's not surprising for us to hear Walmart say, expect to see deflation during the next few months. And this is a really important time of the year, the holiday season, the most important time for retail. And they're suggesting that we should expect prices to go negative on a year-over-year basis. So this is all fitting into the scenario that we've espoused for the last 2 years, which is that this is not a 70s style inflation scenario, that the risk actually is not inflation, but deflation. And there are many companies now that have been relying on pricing to sustain their margins or even increase their margins. They're going to lose that pricing power. They already are losing it. And we think their margins will be under severe pressure unless they use technology. Innovation solves problems. Use technology to shore up margins. So now let's go into market indicators as we wrap things up. I did show this chart, I believe, last month, and I'm struck. It's just astonishing to me that commodity prices today are where they were in the early 80s. Now, given the inflation rhetoric you hear out there, you'd not imagine that to be the case. It was more the case that we had an inflation problem before the 08-09 meltdown. And since then, you can see we've been in a downtrend when it comes to commodity prices, coming down from roughly 230 on this index to 100. And this is nominal terms. We're not adjusting for inflation. If we adjusted this for inflation, you'd be looking at a severe negative. We'd be well below 1980 prices. So I have used the word Kondratiev, which is it's the Kondratiev wave. These are 50-year cycles of prices going up and prices going down. And many people, I think, had been suggesting that we were on the upside of that wave. We have been suggesting that we are not, that we are on the downside of that wave. And this chart certainly bears that point out. Here's oil for the last year or so. And the reason we're featuring it is because oil spiked from July through September when OPEC did cut production. What we believed we'd be looking at this time of year with prices closer to 90, we thought we'd be looking at a comparison November of a year ago, November, December, closer to 70, say 75 to 90. So 20% plus increase year over year in oil prices. And I think that's why a lot of economists and strategists ran with the higher for longer Fed policy. Instead, what do we see? We're now negative on a year-over-year basis, negative oil on a year-over-year basis. And it is pretty astonishing that OPEC is cutting back again, being forced to, and the market's not paying any attention. Why? Demand destruction is real, and it's coming from China. It's coming from the rest of the world as well, perhaps because of hybrid and remote work, and perhaps because there is and has been an accelerated shift towards electric vehicles. And for those of you who ride in Teslas, Tesla Ubers, they save a lot of money on gas. And the capacity utilization of a Tesla as an Uber is much higher than the capacity utilization of my cars, which is maybe 2 or 3% on any given day. So again, another important source of deflation. And I believe this is one of the big reasons that the consumer sentiment index had a nice pop and inflation expectations came down so much. The dollar is another reason inflation is going to surprise on the low side of expectations. Now, if you look at this chart, you see a couple of things. If I had started the chart in 1990, we would be looking at the dollar in the higher end of its trading range for the last 20 some odd years. Instead, we included here the 80 to 85 burst in the dollar when the Fed was so tight. And we had to, the globe, the Treasury officials around the globe and monetary officials got together and said, okay, we have to, this is very deflationary. We all have to ease up. And that's what happened. So the dollar, if you look at it, has been strong, up from 70 to more than 100. So 40%-ish over the last 10 to 12 years. And yet you hear this rhetoric about the weak dollar. It's been very interesting to me to watch so many strategists assume that the dollar was weak and would continue to be weak when actually it's been quite strong. and certainly relative to other currencies. And when the dollar is up, most commodities are priced in dollars. Those commodity prices tend to go down. Another interesting chart, again, we presented it last month, but it is such an important chart. The metals to gold ratio is near its, this would be a 25-year low. And what that means is the purchasing power of gold in terms of metals has gone up dramatically. Purchasing power has gone up. When we say that, use that expression, purchasing power going up, it's usually associated with prices falling. And yet, what did the 10-year Treasury yield do in the green line there? It was going up because the Fed said we had this big inflation problem and it was going to keep increasing rates and they'd be higher for longer. And this chart just says that was a complete mistake. And we know we've already seen one proof that it was a mistake. It was the regional bank crisis in March of this year. And our concern is we are going to see other accidents like that. And for that reason, again, we expect a big pivot from the Fed. And then gold to oil ratio. Now, if you look at this one, since 2014, you'll see that it tends to spike. You saw it spike during 08-09. It tends to spike when there's a fear of a crisis. In 2016, there was, especially early that year, we were sure China was a bust, that the real estate bust was underway. That was a bit premature, but you can see what happened to the gold to oil ratio. During COVID, it skyrocketed. And you can see it's, if you just look at the last 8 to 10 years, is toward the higher end of a range if it gets through 30, meaning gold prices rise relative to oil more, then there is probably some crisis brewing somewhere that we, and as you can see in 2016, sometimes it's not right, but it's all about expectations. What's the psychology out there, especially as it relates to gold? And the last chart here is just a performance chart, year-to-date returns. And just wanted to show you where Bitcoin is. It's been the best performing asset this year. And you can see where other categories of equities and fixed income have been. It's been a pretty good year overall. Bitcoin having an especially good year. And I think it's because in March we learned that Bitcoin is not just a risk-on asset. It is a risk-off asset. And why is it a risk-off asset? It's a risk-off asset because there's no counterparty risk. When everyone was worried about their deposits in the banking system, in March, they were worried because of counterparty risk. Banks are opaque, whereas the Bitcoin blockchain is transparent and it's decentralized, where banks tend to be centralized. So a huge proof of concept. So this realization, wait a minute, Bitcoin is a risk-on asset and a risk-off asset? That's crazy. We don't have too many of those. So pretty interesting. In terms of the sectors that have done well this year, I was surprised. As you know, we are index agnostic, and we think that sectors are converging because technology is blurring the lines between and among them. But if you use the GICS classification, you'll see real estate this is in the last month, real estate, industrials, and financials have been the best three categories. The reason I was surprised by that is it was a very good period for innovation-based strategies like ours which are index agnostic. That typically isn't the case when real estate, industrials, and financials are the best performing categories. Worst were energy, it was the only negative sector, consumer staples, and healthcare. So those last two are more defensive categories. That does make sense in the context of how innovation-based strategies like ours performed. So it's been a great rebound from the lows in October, just a massive rebound, and has transformed the year for a lot of asset managers, either for the better or for the worse. And if we're right, and inflation is going to surprise on the low side of expectations, and growth disappoints, we'll be in a period where innovation does its best. Innovation solves problems. If you need to protect your margins as your pricing power disappears, then you need productivity-enhancing technology. And with the breakthroughs in artificial intelligence, and we marvel all the time about the breakthroughs in AI as AI training costs drop 70% per year. There's a boom out there, and that is what happens when prices drop. And prices associated with disruptive new technologies always fall. So it's a perfect environment for our companies to thrive. And I'll close right now by featuring two pieces we've put out recently. Both of them, interestingly, are on Bitcoin as we get ready for hopefully the SEC's approval of a spot Bitcoin ETF. We think it is going to happen. There are all kinds of signals that it's going to happen. So in a timely way, we put out our Bitcoin monthly in the last week. Check out the health of the Bitcoin network and the ecosystem broadly in that piece. And then we just released our latest Bitcoin brainstorm, which we are in partnership with the Bitcoin Park in Nashville, Tennessee. And those are opportunities for us to showcase the developers out there who are making this new world happen. And you'll get a sense of the depth and the breadth of expertise as we introduce you to some of these important people. So do tune in for that. And then finally, all of our analysts and directors are working feverishly to put together our big ideas for 2024. And I guess I'll leave it there, because the next time I do and in the know, we will be in 2024. So I want to wish you all wonderful holidays with family and friends, and look forward to some more exciting times next year. Thank you.